Hi everyone. I hope everyone is fine. Welcome to our channel. If this is the first time you come to our channel, please watch our previous videos, then you will understand this topic well. I will leave those videos and playlist links in cards. Okay, welcome to Hope Pips, the channel where we turn your trading dreams into reality. Today, we're diving deep into the world of advanced forex trading. Whether you're a seasoned trader or just stepping up your game, this video is packed with strategies to help you trade like the pros. We're breaking down advanced forex trading into 4 game-changing chapters. First, we'll uncover how to identify institutional support and resistance levels with precision. Then, we'll explore 6 powerful trade setups to catch those big moves. Next, we'll master trend identification and session timings without relying on fancy indicators. And finally, we'll tie it all together with real-world examples, showing you how to combine these techniques for maximum profit. This video is designed to be your ultimate guide to trading institutional levels with confidence. So grab your notebook, fire up your charts, and let's get started. If you love what we do here at Hope Pips, smash that like button, hit subscribe, and ring the bell so you never miss a video. Let's make those pips rain. Chapter 1: Identification of Institutional Support and Resistance. Welcome to Chapter 1: Identifying Institutional Support and Resistance. These are the levels where the big players, the banks, hedge funds, and institutions, place their orders. Mastering this skill is the foundation of advanced forex trading. Let's break it down with 5 key rules to ensure your chart screams opportunity. The rule number 1 is keep your chart clean. No indicators, no drawings, just raw price action. A clean chart lets you see what the institutions see, pure market structure. Cluttered charts with moving averages or oscillators distract you from the real story. Start with a blank canvas and let price guide you. The rule number 2 is look for a clean range to mitigate. A clean range is a price zone where the market consolidates. Think of it as a battleground between buyers and sellers. These ranges are where institutions build their positions. Look for areas where price moves sideways, forming clear highs and lows. Avoid choppy, messy zones where price action looks like a scribble. The rule number 3 is the range must be significant. Chapter 1: Identification of Institutional Support and Resistance. Welcome to Chapter 1: Identifying Institutional Support and Resistance. These are the levels where the big players, the banks, hedge funds, and institutions, place their orders. Mastering this skill is the foundation of advanced forex trading. Let's break it down with 5 key rules to ensure your chart screams opportunity. The rule number 1 is keep your chart clean. No indicators, no drawings, just raw price action. A clean chart lets you see what the institutions see, pure market structure. Cluttered charts with moving averages or oscillators distract you from the real story. Start with a blank canvas and let price guide you. The rule number 2 is look for a clean range to mitigate. A clean range is a price zone where the market consolidates. Think of it as a battleground between buyers and sellers. These ranges are where institutions build their positions. Look for areas where price moves sideways, forming clear highs and lows. Avoid choppy, messy zones where price action looks like a scribble. The rule number 3 is the range must be significant. We're not chasing small wiggles here. The range between the high and low of your support or resistance zone should be substantial, at least 25 pips. This ensures the level has enough room for institutional orders to cluster, giving you a high probability setup. The rule number 4 is stick to higher time frames. Use a time frame of 15 minutes or higher. Why? Lower time frames are noisy and filled with retail traps. Institutional players operate on the 15-minute, 1 hour, or even 4-hour charts where the real moves happen. These time frames filter out the noise and reveal the levels that matter. The rule number 5 is focus on recently formed key zones. Institutional levels lose their strength over time. The fresher the zone, the more likely it's still relevant to the big players. Look for support or resistance zones formed within the last few candles, ideally within the past day or two on your chosen time frame. Old levels are like stale bread. They might still work, but fresh is always better. To identify these zones, scan your chart for areas where price repeatedly bounces or rejects. These are your support and resistance levels. Draw horizontal lines at the highs and lows of these ranges, but keep it minimal, only mark the most obvious zones. In the next chapter, we'll use these levels to spot killer trade setups. Let's move on. Chapter 2: Identification of Setup. Nothing but the confirmation candle. Now that we've got our institutional levels, it's time for Chapter 2: Identifying Trade Setups. We're diving into 6 powerful setups that turn support and resistance into profitable trades. I'll explain each setup using candlestick chart concepts, focusing on price action without mentioning specific values or currency pairs as requested. Let's visualize these on a candlestick chart and break them down. Let's see the setup 1, breakout setup. Imagine a resistance level on your chart. A ceiling price keeps hitting but can't break. Suddenly, a strong bullish candle pushes through and closes above this resistance. This is your confirmation candle. It signals the institutions are ready to buy. Your entry: wait for the next candle to break the high of that confirmation candle for a buy trade. For a sell trade, picture a bearish candle breaking and closing below a support level. Enter when the next candle breaks the low of that confirmation candle. This setup thrives on momentum. I think you understand this setup. I think you understand the breakout setup. Now let's see the setup number 2, impulse entry. This one's for the bold. When a bullish candle smashes through a resistance level, you don't have to wait, you enter immediately after the break. The candle itself is your confirmation candle, showing institutional conviction. This volume itself drives the candle. Moreover, place your stop loss at below the previous candle low. In this setup, you have to be very cautious. Now for a sell trade, a bearish candle crashes through support and you jump in right away. Place tight stops to manage risk, means your stop loss must be above the previous candle high, as this aggressive setup thrives on quick, decisive moves. Okay, if understand this setup, please like this video. Now let's see the setup number 3, counter trend. In an uptrend, price hits a resistance level and a bearish candle forms, rejecting the upward move. This is your confirmation candle when this bearish candle breaks and closed below the previous bullish candle, hinting at a reversal. Enter a sell trade when the next candle breaks the low of this bearish candle. Your stop loss must be above the high of the confirmation candle. For a buy trade in a downtrend, a bullish candle forms at support, rejecting the decline. Moreover, it closed above the previous bearish candle. That's why we mark it as confirmation candle. Enter when the next candle breaks the high of that bullish candle. Stop loss must be below the low of the confirmation candle. This setup catches reversals against the prevailing trend. Let's see the setup number 4, A plus setup. This is a high probability gem. In a downtrend, a bullish candle forms at support, but stays within the range of the previous bearish candle, which breaks and closed below the support. This bullish candle closed within the previous candle, showing hidden buying strength. Enter a sell trade when the next candle breaks the low of this confirmation candle. Our stop loss is above the confirmation candle. For a buy trade in an uptrend, a bearish candle forms at resistance within the range of the bullish candle and closed within the previous candle range. Enter when the next candle breaks the high, and the stop loss is placed below the confirmation candle low. This setup is subtle but deadly effective. Practice well, then execute in real market. Let's see the setup number 5, reversal entry. In an uptrend, a bullish candle forms at support, reinforcing the trend strength, and it must be closed above the previous candle high. This is your confirmation candle. Enter a buy trade when the next candle breaks its high. Place the stop loss below the confirmation candle low. For a sell trade in a downtrend, a bearish candle forms at resistance. It must be closed below the previous candle, confirming the trend's continuation. Enter when the next candle breaks its low. Place your stop loss above the confirmation candle high. This setup rides the trend's momentum for steady gains. Let's see the setup number 6. Exhausted candle. For a buy trade, look for a bullish exhausted candle at support, a candle with a long lower wick showing sellers tried but failed to push price lower. Enter when the next candle breaks its high. This is our confirmation candle. Place your stop loss below the confirmation candle low. For a sell trade, a bearish exhausted candle at resistance with a long upper wick shows buyers losing steam. Enter when the next candle breaks its low. This setup exploits market exhaustion. Place your stop loss above the confirmation candle. These 6 setups are your trading arsenal. Practice spotting them on your candlestick charts, focusing on how price interacts with your institutional levels. Next, we'll learn how to time these setups with trends and sessions. Chapter 3, Identification of Trend and Session. Welcome to Chapter 3, Identifying Trends and Sessions. Timing and trend direction are critical for catching institutional moves. We'll cover how to spot trends without indicators and use session timings to trade high volume periods. Let's break it down. Trend identification without indicators. Indicators like MACD or Bollinger Bands can lag, price action doesn't. In an uptrend, price forms higher highs and higher lows like a staircase climbing upward. Each support level holds and price pushes to new peaks. In a downtrend, you see lower highs and lower lows, descending like a staircase. To confirm a trend, look at the candlestick patterns on a 15-minute or higher time frame. In an uptrend, bullish candles dominate with shallow pullbacks. In a downtrend, bearish candles lead and rallies are weak. Study the sequence of highs and lows to map the market's direction. Using Session Timings Indicator on TradingView. The Forex market pulses with the rhythm of major sessions, London, New York, and Asia. On TradingView, the Session Timings Indicator highlights these periods on your chart, showing when each session starts, overlaps, and ends. Set it to display London 3 a.m. to 12 p.m. Eastern Standard Time, New York 8 a.m. to 5 p.m. Eastern Standard Time, and Asia 7 p.m. to 4 a.m. Eastern Standard Time. These sessions drive liquidity and volatility, which are key for institutional setups. Watch how price reacts at session boundaries to spot potential moves. High volume timings. 3 moments spark big action. First, session starts London Open at 3 a.m. Estate or New York Open at 8 a.m. Eastern Standard Time often triggers sharp moves as institutional orders flood in. Let's see the second, session overlaps. The London-New York overlap between 8 a.m. to 12 p.m. Eastern Standard Time is the market's peak, with tight spreads and high volume. Okay, the third session closes. London close at 12 p.m. Estate or New York close at 5 p.m. Eastern Standard Time can see final pushes or reversals as positions unwind. Align your trade setups with these timings for maximum impact. By combining trend analysis with session timing, you're trading when the market is most active. Let's see how it all comes together in Chapter 4 with real trade examples. Chapter 4, combining all three chapters. Now for Chapter 4, combining everything. Let's see how institutional levels, trade setups, and trend session timing create winning trades. We'll walk through 5 trades, combining the rules from the first 3 chapters. We'll keep examples general, focusing on the process. Let's see the first example. Wow, see this. The trend is bullish, higher highs and higher lows. So our first rule identifying the trend is satisfied. It's 3 a.m. Eastern Standard Time, London Open, a high volume period. This timing is perfect to trade. So our second rule trade only in high volume timings is satisfied. A fresh support zone, at least 25 pips wide, formed within the last day. This is our third rule identifying the key zone. This is a breakout setup at London Open. On a 15-minute chart, we have to identify the current trend of the market. A bullish candle breaks and closes above the resistance of our zone, becoming the confirmation candle. This is our fourth rule, mark the confirmation candle. The next candle breaks its high and we enter a buy trade, placing a stop below the support or confirmation candle low. And our target is at the next resistance. Okay, let's see what they did here. Price rockets as institutional buyers drive the breakout. Let's see the next example. Here is our chart. See, this is a reversal entry in uptrend. Price forming higher highs and higher lows. So it is an uptrend. Our first rule, that is identifying the trend, is satisfied. On a 1-hour chart, we mark a recent support zone in a clear uptrend. The range is clean on left side. And more over this is the recent key zone. So this is our official support. The second rule, identifying the key zone, is satisfied. And also this is during the London-New York overlap. Our third rule trade in high volume timings is also satisfied. A bullish candle forms at this support, reinforcing the trend. It closed above the previous bearish candle high. So we can assume that volume came into the market. So we consider that this is our confirmation candle. Finally, our fourth rule trade after confirmation candle is also confirmed. The next candle breaks its high and we enter a buy trade, stop below the support, or we can place it at just below the entry candle for better risk to reward ratio. Our target automatically is placed at next resistance. See, our target got hit. The trend and high volume timing fuel a strong rally. Okay, it's getting interesting. Let's see the next example. Before getting into that, Please subscribe to our channel, like the video, and share with your friends. Okay, let's see it. Okay, it is a counter trend at resistance. First of all, we have to identify the trend. Okay, as you know, price clearly forms higher highs and higher lows. See, price drops here and retrieve, drops and retrieve, and same pattern. So we confirm this is a downtrend. Okay, our first rule identifying the trend is satisfied. Let's use this in high volume timings. The market present is in the overlap of London and New York session. I think this is the best time to look for the entries. So our second rule trade in high volume timings is satisfied. Now identify the key zones. As you know, this is our recent resistance and this is our recent support. Because on the left side it has clean range. We have more range to mitigate. On high scale, we can take it as a key resistance zone. Okay, our third rule identifying the key zones is also satisfied. Okay, on a 15-minute chart, we spot a fresh resistance zone in an uptrend. At New York and London overlap, a bearish candle forms at this resistance, rejecting the uptrend by closing below the low of previous bullish candle. Make sure that this candle must break the previous candle low and close below it. Okay, we can take it as our confirmation candle. Yeah, the final rule means the fourth rule marking the confirmation candle is satisfied. We can take sell trade only after the next candle breaks the low of the confirmation candle. As we anticipated, the next candle breaks its low and we enter sell trade. Stop loss can place in three ways. One is above the resistance, second one is above the confirmation candle, and the third one is just above the entry candle. Up to your risk, you can take any of this. And obviously our target is placed at the support. Let's see the result. As we anticipated, the price moved up to the resistance. That's why we have to follow the rules. The counter trend move captures a quick reversal. This is how I am taking sell trades daily in like market. But you don't have to directly take in the live market now. First, practice in the past data. You practice in TradingView platform, OneChat platform, or the Soft4FX platform. I am personally using the Soft4FX platform. It is not free, you have to pay a lot for the simulation. But for our subscribers, we are providing it for free. To access that platform, you have to do just two things. One, please subscribe to our channel and visit our Telegram group. I will provide the all links in the description and in comment section. Okay, let's see the next example. Okay, I think this is a A+ setup. Okay, our first step is to identify the trend. As you see the price forming lower highs and lower lows. So we can consider it as a downtrend. Our first rule identifying the trend is satisfied. Let's see the session timings. As you see, this is an Asian session. Okay, we can take trade at this moment. Our second rule trade in high volume timings is satisfied. On a 1-hour chart, we identify a support zone. It is a very recently formed support and it has a clean range on the left side. That's why we mark it as our support zone. So our third rule identifying the key zones is also satisfied. During the Asian session, a bullish candle forms within the range of the previous bearish candle which breaks and closed below the support. This A+ confirmation candle signal trend continuation. So our confirmation candle is marked. Okay, finally, our fourth rule identifying the confirmation candle is satisfied. Next, we enter a sell trade when the next candle breaks its low. Stop loss is above the support. As you see, the setup nails a stealthy move. Let's see the final example. Let me know the trend of the market by commenting below. So in this example, the first rule is you have to do it. This is at the London-New York overlap. So the second rule is satisfied. See here, this is an exhausted candle in downtrend. On a 15-minute chart, a support zone forms in a downtrend. So the third rule also satisfied. A bearish exhausted candle with a long lower wick appears at resistance, showing buyer fatigue. This is our confirmation candle. The final rule also satisfied. The next candle breaks its low and we enter a sell trade stop above the support. The downtrend continues, amplified by the session's volume. Yeah, examples are completed. These examples show how to blend clean zones, precise setups, and optimal timing. Practice these on your charts to trade like the pros. That's it for today's masterclass on advanced Forex trading. You've learned how to spot institutional levels, master 6 trade setups, identify trends, and time your entries with session volatility. Plus, we combined it all with 5 trade examples. Now take these strategies to your charts and start hunting those pips. If this video helped you, smash that like button, share it with your trading squad, and subscribe to Hope Pips for more. Drop your questions or trade ideas in the comments. I read them all. Follow us on social media for more tips and check out our other videos for trading gold. Until next time, trade smart, stay focused, and keep stacking those pips. This is Hope Pips signing off.